Welcome to yet another shallow dive. Today I'm going to be looking at People's Bancorp. It's a company that came up on the stock screener when I was doing my previous video, so I decided to dive a little bit into it and see if it deserves a deeper dive. Perhaps maybe a good investment. So what I'm going to do is I'll use stockanalysis.com to try to figure out whether the numbers of this company make sense, see if the numbers can tell us anything about the company. I'm going to go through a bunch of numbers. I'm going to go through the website, see if that can tell us anything, and then figure out whether the company makes sense or not. So first, what I like to do is do a little overview of the company. When we go to the profile here, you'll see that People's Bancorp is basically a regional bank that operates in the northeast of the United States, maybe 5-6 states. I went to the website and there's actually a map and it tells you which states it's in. You can actually zoom in and see where the exact branches are located. So that's cool. The website didn't actually tell me much else because I have to kind of like log in and figure out what the interface looks like. But it looks fine. It doesn't look. There's nothing strange about it that I can see. So then, when I dive here into the numbers, the first thing I like to look at is the revenue. So I go to quarterly, so it can give me a little bit more clarity on what's going on quarter to quarter. And the revenue of this company looks pretty solid. For a bank, you'll see that there is a big boost in revenue here around the 2021, the beginning of 2021. And I didn't know why that was when I was searching this company earlier, but I guess my guess was that they acquired some other company, and that's exactly what happened. I think the company's name is Limestone. Reading through some headlines, you can kind of see it. One thing that's a little bit weird though is that you see how there's these little like ambulance chasing articles. Sometimes that can be a bad sign and sometimes it's really nothing. But it's worth exploring further. So it's not exactly like a red flag for the company, but it's definitely like a mildly yellow flag to where, hey, why don't we just look in here, and why do these people spam? Is there something potentially unfair that's being done here with this acquisition? Another little window that I like on stockanalysis.com here is this window that you can see kind of the revenue and earnings at a glance. So that's pretty cool. The bank makes about $45-50 million a year in profits, according to this. Now, going back to the financials, the next thing I like to look at is the operating income or the net income, which basically tells us the same thing as we just saw, except on a quarterly basis. So far this year, the company's actually done a lot better. It's been averaging about 25 million per quarter. So that's, twice the amount of earnings that the company usually gets. Now they spent, part of that is probably because of their acquisition, and you can see the last quarter. Is that the last quarter? Which quarter is this? In September 29, 2021. Yeah, probably last quarter of 2021. That's probably when they spent some money and shares in order to acquire the new company. And this is the result. I mean, it's a doubling of revenue basically. Now, they probably paid cash and shares because you'll see that there's been some share dilution here in the last, they've issued maybe 7-8 million extra shares, probably because of the acquisition. So there's some share dilution, but in general, though, they actually try to buy back shares whenever they have money. So if you see that the trend up at the top is actually very mildly down. So that's good to see. So I think I'm pretty much done here with the financial tab. Profit margin is a good number to watch. Probably averages in like mid 20s, low 20s. Next thing I like to do is go to the statistics, and you can see that there's a difference between the enterprise value and the market cap of the company. That means that there is some debt. Okay, and I look down below in a shortened balance sheet, and it looks like it's about 92 million. That's not too worrying because 92 million, you can find it right here. 92 million is actually the amount of profit they make per year. So with just 1 year's profit, they could make up all of the debt that they own. Plus, on top of that, banks use debt in order to make money. Okay, so it's very normal for a bank to have debt, and I wouldn't be surprised if a bank like this is even like 100% leveraged, because they take out debt sometimes to finance other debt and they collect the spread. That's kind of how banks operate. So this bank has a potential to make even more money. Looking at the ratios real quick, you'll see that the PE ratio is 7.71. Enterprise value to earnings is 9.04. Now, for those of you who don't know and are new to analyzing stocks, the enterprise value just means that the market capitalization of the company minus the debt or cash. So market capitalization is basically the price of the company. So you'll see that the market cap, for example, is 830 million, and then enterprise value is 923 million. So if we take the enterprise value, which is the price of the company, and subtract the debt, we'll get the market cap, 830. So it's good to know both numbers, really. So moving on, price to earnings is 7.71, like I mentioned. EV to earnings, enterprise value to earnings is 9.04, which is pretty low. Not too abnormal for a bank, but it looks like this bank is kind of, not aggressively, but it is acquiring other banks and it's trying to swallow other banks. And so actually it's kind of growing. Now, you can't really call that a growth company though, because they're just kind of growing sideways through acquisition. They're not like, growing internally, and they're not collecting, they're not kind of like taking over the industry. They're just swallowing banks that are doing the exact same thing what they do. So if they acquire a new bank, they have to actually issue new shares or pay cash, and that's coming out of the company's funds. And it's basically a trade-off. It's just the company's getting bigger, but it's not necessarily getting any more profitable. If that makes any sense? So other things I like to look at here is enterprise value to free cash flow. It's at 5, which is very low. It's extremely low. So it tells me that that's a very money generating business, which is hard to find nowadays. I mean, the reason why I stumbled this is because I looked for companies that are kind of like growing quarter over quarter and have decent statistics, and I just couldn't find anything outside of energy in the past couple years that has been doing well. Now, this company is not totally not exposed to energy. It's exposed to a little bit of construction and things like that, and I'll get into that in a second. But before we do that, let's look at the return on equity, which is 12.8%. Return on asset, return on investing capital in the low ones, or between 1% and 2%, which is fine. The margins here, banks for some reason always have gross margin of 100. I guess because they don't really have any outlays other than like digital. I don't know. But either way, the profit margin is the one that matters because it's after a lot of deductions here. So it's sitting at 31%. So speaking of exposure, what I did was I went to check out the 10Q of the company to figure out like all the money they're lending, what is going on with that money and how it's positioned. So here it is. This is the loan balances on the books as of September 30th, 2022. We can see that construction, commercial real estate, and commercial and industrial loans are pretty much the bulk of it. Residential real estate as well. The numbers on the right will tell you the exposure. They're not really exposed to credit cards as much, or consumer direct, consumer indirect. So that doesn't comprise a large part of their loan amounts. So they're tied to basically housing, commercial real estate mostly, and some industrial. So real estate, commercial real estate, and industrial. A tiny bit of construction. So unless the commercial real estate and real estate experience a big collapse, like this bank will probably do just fine. And even if it does experience collapse, it's still going to be just fine. Like its price might half, but it's going to recover with the markets and will probably regain its valuation at the current state. So I'm not too worried about, the bank running out of business anytime soon. So as far as how it's been moving, this is a chart of uh, the stock performance over the past like 15 years or so. And it looks like it's moving all right. It's basically keeping its value. It was as high up as 28 back in 2007. Then this is the first drawdown here you see right above where my face is. That's 2008 crash. So the company dragged down for a little bit with the rest of the banking sector during the financial crisis around $8 to $12. And then it's been a steady rise ever since recent days. There's a little bit of a window here where it dipped pretty aggressively. I'm guessing that's because of the acquisition was around this time. So, there are probably doubts whether or not the company can integrate successfully, and the swallowing of, the other financial institution, whatever the, Limestone or whatever happens to be. The stock market basically expressed some doubt whether that's going to be successful or not. And another thing that happened here is, of course, March of 2020. So a lot of virus interruption here. So the entire market dropped anyways. And all the banking sector went along with it. So part of it could be because of the acquisition, but most of it is just that's how the banking sector moved back then. In 2020, it was kind of scraping along the bottom before a resurrection, in the late 2020, early 2021. And then sideways grind ever since, which is fine. It's slightly below its moving averages, but that's nor here nor there. I'm not really a technician, and I don't put much weight on technical indicators like that when it comes to especially valuing a company, right? So this is the chart of the company. Its ticker symbol is, let's go back here, PEBO. PEBO, okay, People's Bancorp. So if you want to check it out, that's fine. I would suggest diving deeper into the company if you think it's something that you like. I think right now in this market environment, like I mentioned, it's, in my opinion, a very good idea to buy some income generating assets because we don't know what's going to happen with rents. I mean, buying treasuries is fine, but they're not necessarily going to keep up with inflation in the long run. So it's a good idea to own some stocks. So if you're like very conservative investor and you own a lot of cash already and a lot of treasuries, this bank perhaps could make a good addition to your portfolio. By the way, nothing I say on this channel is ever financial advice. I'm not a financial advisor, first of all. I'm not even a CPA or anything like that. I'm just an investor just like you. So please do your own due diligence. And what I would start with is just trying to look at some articles by analysts of this company to try to figure out whether it's, the action is something that you like. There is a little analyst forecast here on the main page, which is, I don't know how much credence you want to give to stock analysts. People like to talk trash about stock analysts, on the internet and on Twitter, but at least they've looked into the company. And the consensus is basically a mild buy. I mean, there's 7 people say hold, 4 people say buy, and 2 people say strong buy. We don't know over what kind of time periods and whatnot, but so far, by what I'm seeing, it looks like you're not going to lose any capital holding this company. So that's kind of my takeaway from the whole situation. I discovered this company through screening, like I mentioned, and if I get some extra cash at some point, let's say the market turns up and I'm able to exit some positions, I may even put some money in there. Oh, I didn't. One thing I didn't talk about is the dividend. So they pay out a dividend which is very big. Okay, it's over 5% dividend, which is huge. 5.1%. The dividend growth is 5% over a year. So if you think inflation is going to be, less than 5% per year, then this would be a good dividend growth for you. The payout ratio is 38.5%. Now, what is payout ratio? Payout ratio basically means what portion of their earnings does this company dedicate towards paying the dividend. So if that percentage is over 100%, that's bad news, right? Because they're going to be cutting the dividend most of the time. If it's very low percentage, that means the dividend is fairly safe, and they're going to keep paying the dividend for a pretty long time. Now, this company does have some debt, but that debt is basically generated because of acquisitions. It's not really generated because of like operational problems, like running the company to the ground, something like that, where they're paying, let's say, too much to employees, they're not profiting enough, or whatever kind of deficiencies the company might have. So the debt is not really, in my opinion, a problem here. If you own this company or thinking about buying it, let me know what you think about it. I like to do these little company reviews on the weekends or whenever I have a chance. I also do a weekly or daily sometimes vlog, like a video log of a investment account that I run that's completely public. Currently it's sitting at about 180K, and I review every single position whenever I can during the week and update everybody on all my latest moves and what's been going on with the account. So check that out if you want. And if you want me to review a company just like this and do a shallow dive on a company that perhaps you're interested in, let me know in the comments, and I'll do my best. So far I've done every single one that's been suggested in the comments, besides some foreign ones because they're really hard to find on a stock analysis website. And the numbers can't necessarily be trusted, not because the company is dishonest, but because of the accounting rules in other jurisdictions around the world are just different, and I don't know the ins and outs, and my confidence of reading them correctly is low. So you might not get as much value out of my look based, if it's a foreign company. So some domestic company that I can look up on stockanalysis.com would be just great. And so if you have any suggestions, put in the comments down below and I'll take a look at it, all right? I guess I'll talk to you later. Peace.